my name is Jim Balzer. I'm the host of Spectacular Chicago, and today we have a special guest, Jeff Collins, tax lawyer, accountant, former IRS agent, to talk to us about what to do when you have received notice from the IRS asking for money. Welcome, Mr. Collins.
Thank you. Appreciate being here.
All right. So can you take us through a little bit what happens when the IRS is contacting us, asking us for money? We have a business and we're perhaps behind in payroll taxes or some issue, and they're sending us a notice. What might next steps be?
Well, the first thing that should happen is there has to be some reaction. We have to find out what's going on in the situation. It typically starts when someone receives a notice or a series of notices, and it'll show some amount it's being owed. It'll show some pending action that the government will take, and we have to just find out what is the bottom line here. What's the situation? What do we need to do to resolve this liability, if it is a liability, and to make it all go away. One thing for sure, it does not go away by taking no action.
By the time you're getting this notice in the mail, you can expect that something is in process, an action is underway, and the IRS is looking to you for money. And the issue is for you at that point to disprove that you owe that money. Is that a fair assessment?
Maybe. Most people who receive these notices already have some expectation of why. And so there's less of a need to disprove what you owe as it is to really identify what should be the amount and then what should be the action taken. When a notice comes in, I think most people who receive those understand that they have had a series of non or late payments to the government for, say, income taxes or payroll taxes or whatever it might be. I'm sorry.
So as it relates to a business, however, at that point it's usually relating to non-payment of what type of taxes?
What I've seen usually for businesses is going to be either income tax, and a lot of our smaller business owners have those problems, but also with employment taxes, payroll taxes. That's the type of situation where as most businesses go through their cash flow cycle, sometimes they're doing better, sometimes they have more cash than others. What we see a lot of times during those periods where cash is slow is some payment goes by the wayside. It's usually not the rent. They have to keep their lights and the phones on. They'll make their payroll with those net payments. And when you know what I mean when I say a net payment, you make $100 and your paycheck is $90. That's the net.
Right.
Okay, well, there's another $10 or whatever the amount is that comes out of your paycheck, and that amount is held actually to be paid to the government. What so many business owners will do is when they're meeting payroll and all those other expenses have to get met, something goes by the wayside. It's usually that amount that they're deemed to hold to pay over to the government.
Okay, and when that occurs, then they have to take some action. So when you're getting the call to discuss that with a prospective client or new client or somebody that's concerned that they have an IRS situation at that point, what normally do you tell them?
Well, it depends. When I get those calls, it's usually from someone who is already very stressed out and they need solution because they have no peace at home, no peace in their business until they get some resolution. They're also fearing what's going to happen next from the government. What I like to do is explain to them, first of all, what will happen if they do nothing, and that's pretty clear. The Internal Revenue Service has actually a series of steps that's outlined in its rule book of how they can go about collecting tax. So after explaining that yes, possibly they can garnish or levy is what it's called, your bank account, seize assets, possibly even contact people who owe you money for direct payment, to say, instead of sending that to you, to send it to the IRS. So after explaining that, they have an understanding that they should take some action. The action then is seek a resolution. What does that resolution mean for the IRS? They just want to collect the money. For you as the taxpayer, the potential client, it may not be that simple. Most of my clients don't have a store of funds in the bank to just write a check to make it all go away. If they did, they probably wouldn't have received the notices in the first place.
Sure.
Yeah. So what is expected, what's usually desired, is some form of payment alternative, collection alternative. That's what the IRS calls it. Whether it's a payment agreement or some deferral of the amount that maybe we'll pay it later, or there's some deal struck, which is actually a nice little program called Offer and Compromise, where a deal is struck to say, yes, we know that the liability is so much, 100,000, 200,000, whatever it may be, but we don't have that much, and we're not going to have that much. So we make this offer as a compromise to the liability.
Okay. Yeah. So they'll look at the situation and determine that this isn't just financial planning, but they'll look at your records and say, okay, this is their actual financial posture, and say yes or no to some possible arrangement.
Right, absolutely. Now, in doing that, we do have to present a financial profile for the client. And because of that, I always advise clients, don't go make that communication with the IRS by yourself. Not when the liability is very large, because the Internal Revenue Service will compile a lot of information about your assets and your income, people who owe you money, your bank accounts, titles to your vehicles, your home, your other real estate. If you own rental property, who your renters are. They'll compile quite a bit of information. And so we don't always have to provide the same information that you may think. So I always caution clients, get some good representation so that you don't make the mistake of providing information that you were never supposed to.
Okay.
Yeah.
So the IRS works a little differently than when you owe money to somebody else and they have to take you to court. They have that, if they say you're owed that much money, they can just go after. They don't have to sue you, but if you want to defend it, then it's your job to.
I see what you mean. A typical collection situation, let's say that someone opens a credit card, charges up the balance, and then doesn't pay. Well, certainly the credit card company wants to collect on that balance. Their process is, yes, they do have to sue you in a public court and get a judgment, and then seek the court's assistance for collection. Well, the Internal Revenue Service, and for that matter, state governments, they're a little different. They don't have that because they've been given the power by our Congress, by our legislature. They've been given the powers to have their own process. And in fact, the Internal Revenue Service has its own collections division. That's what they do. They don't have to prove it in court. On the other hand, if there needs to be some review, some tribunal, if there needs to be a day in court, the taxpayers, the public, clients, they do have the ability to get their day in court. But it's a little opposite. The person who's owed the money doesn't have to go in court. The person who owes the money may have to go into court. And that's one of the options. Not always the best option, not even always immediately available option when dealing with the IRS, but it certainly is one option.
Okay.
Interesting enough, sorry to cut you off, there's actually a separate court system specific for the IRS. It's called the United States Tax Court. And this is the only venue where it's permissible to go into the court and challenge something by the IRS, a determination or a liability or an assessment of tax, where, to challenge before the tax is actually paid. And so there's always a very small window where someone can do that. But after that window passes, the only opportunity for that day in court is to go into the U.S. district courts to fight the IRS. Basically, we're suing the federal government. We're suing the Internal Revenue Service. So you can do that in U.S. district court. The problem is you have to pay the tax first and sue for a refund.
Okay, or while you're in court, it doesn't hold that in abeyance. They're still pursuing the collection even though you're in court. Or do you have to show the court that you've paid it first before you avail yourself of the remedy there?
Actually, for a matter of collection, so again, I gave two situations. One was more extreme, the U.S. tax court, where you pay the tax and then sue for a refund. We're not so much talking about that. When you have the access to the U.S. tax court and you do file for some action there, well, certainly it stops the collection activity that you're contesting. It stops the examination or audit activity that you're contesting there. U.S. tax court's a wonderful thing.
And it sounds like you've represented quite a few clients in that environment. You can give some interest. You were telling me earlier about some interesting examples you had. If you care to share one or two,
I can maybe share one or two. Well, to answer your question, yes, I've represented clients before the U.S. tax court, and it's a national court system actually. So my license to practice is actually throughout the United States and its territories. I've represented people in tax matters as far north as Alaska, as far south as Puerto Rico, both coasts, Midwest, East Coast, Pacific. And there have been some interesting cases. There have been. These cases tend to be layered with other situations though, and that's what really colors them to make it interesting. The tax court really wants to hear the bottom line of, is the money owed? Is there some evidence or proof to say that it's not owed? Did the IRS do what it was supposed to do? And if it didn't, prove that it didn't do what it was supposed to do so that you're offered some relief. But the coloring in those stories is what makes it really, really interesting. There was a client who is a very colorful character, a professional gambler. He considered himself a professional gambler. Well, this guy was full of personality, and we did have to go into the U.S. tax court and to handle and deal with his situation. He was actually contesting the amount of liability that the government said that he owed. Unfortunately, he missed that opportunity. So the U.S. tax court case basically went away very quickly. However, through some planning and some structure, we had to lay out a unique strategy for this individual. We were able to completely resolve his tax liability. He was happy. The government was satisfied. But in his situation, I mean, obviously at some point he was a very successful gambler. He won a lot, he lost a lot. In the process, he accumulated a tax liability of $1.8 million. That's a lot of table winnings.
Yeah. Where'd all the money go?
Well, apparently it went back to the table.
So you win it, and then it goes back.
You win it, it goes back, and we did have a long-standing battle with the IRS over whether that was actually the amount. At the end of the day, though, He paid about $200 of that liability.
200.
200, and the amount went away. He was satisfied. The government was satisfied, and that entire strategy that happened with him was all absolutely within the confines of the law.
Okay, so there's knowing what buttons to push and where is.
Strategy is laid out based according to the individual facts of the situation. I mentioned a few times this individual was rather colorful, and it was his unique facts of his lifestyle which enabled that situation. We actually tied in not only using the U.S. tax court system, but also the U.S. bankruptcy system and the laws there. So there's always a series of layers in everyone's situation. It's always driven by facts.
Well, the takeaway from that is it's not a matter of innocent until proven guilty. You have to kind of prove actually a negative, which is not the typical civil proceeding. You have to prove that you don't owe it versus they may say you owe it and they have that, but the burden's on you to prove that negative.
It is, and I hear that. I've never heard it put that way. You have to prove the negative when referring to these tax situations, but actually that's exactly what it is. And it seems on the surface that that's very unfair. We're in a society where we're innocent until proven guilty. Well, that's a little different situation. Here, where we're talking about a matter of tax liability, it's not really a matter of innocence. It's a matter of the right number. What's the actual liability? So the person who's best situated to prove that they did owe the money or didn't owe the money is actually the taxpayer instead of the Internal Revenue Service. And that's why you have that reversal.
Okay. So again, at the time you're getting that notice, they've pretty much gone through some numbers or some logarithm or some data to determine that's owed, and that's why you're getting that notice. As it relates to a business owner that is faced with these consequences, if you will, when they get this notice, or maybe this notice comes to them, but somebody is responsible for paying. If it's a business, somebody is responsible for paying those taxes, or they might have a personal liability. Unlike you're shielded in a company from other liabilities, that's not always the case with tax liability. Am I correct in that?
Well, there's two sides of that. Most common with the people that you know, the people who contact me, most of those IRS collection situations for small business owners, Joe's Plumbing, Nellie's Bakery, most of those situations, it's only going to be one of two types of liability that we'll see. Income tax, and that's where you make money and you're taxed on the amount that you make, and you're supposed to pay that tax when you file the tax return. And sometimes that happens, and as we know, sometimes it doesn't happen. For businesses, though, the other side of liability that we see that actually more relates to your question is what's called it's employment tax. And just to explain how employment taxes work, for every dollar that's withheld out of an employee's paycheck, now there's a few different components. There's state income tax, there's federal income tax, and then there's also the FICA and Social Security taxes, and that is what is matched by your employer. So again, if $10 is withheld out of your paycheck and you receive 90, well, maybe not the full 10, but some part of that is also matched by your employer.
Yes.
Okay. And in our example a little earlier, where a business runs short on funds, and the one thing that doesn't get paid is that payroll tax liability, well, it contains all those components, the portions that were withheld from your paycheck, as well as the portion that the company matches. So you asked about a matter of responsibility. Yes. In every one of those collection situations, there is a at some point finding a determination of who's the responsible party for it. And the reason why, even though the government will seek collection from the company itself, it's going to guarantee or better its chances of collecting at least the part that's been taken out of someone's paycheck.
Right.
And they're called trust funds. The reason why is because those funds were withheld, that $10 was withheld from your paycheck, entrusted to be paid over to the government.
Yes.
So the money doesn't belong to the company, it belongs to the government. Trust funds.
Yes.
Okay, so the IRS created what's called the trust fund penalty for that responsible person. If it was your job, your responsibility, your decision to withhold those funds, but instead you didn't pay them over, well, you may be responsible for that trust fund penalty, which is the portion that you withheld from someone's paycheck, but didn't pay it over to the government.
I wonder if that thought process should be applied to all the state officials who don't properly pay their bills. You know, as we're in Illinois, we have quite a bit of challenges, fiscal incontinence, I'd like to call it. And if those public officials who are charged with the responsibility of paying the bills and they don't pay the bills, well, maybe somebody should come after them in that same way. That would probably resolve quite a few issues.
It probably would, but what I think would happen would be
Nobody would run for elected office anymore.
no one would run for elected office anymore, and the government would only cause a lot of homes and vehicles to be foreclosed because most of these elected officials never really stockpile as much cash as they do assets. So if we ever did that, it may be the country's biggest fire sale on luxury homes and exotic cars. And it may be a few other amenities, but
It's high time.
Back to that discussion though about this trust fund taxes. So this is what happens then. A company that maybe had a shortfall in funds when it was time to meet payroll, they tend not to do that just once. That tends to happen over a period of months and sometimes years. And as you can imagine, if after every payroll there's some shortage, there's some amount that was not paid over to the government, which should have been, well, that liability is going to accumulate into a very large amount. And in fact, I think I mentioned this earlier, so many of my clients, most of my clients have liabilities in excess of $100,000. The way that amount escalates is not that the business made so much money that they amass an income tax liability that great. It's that their payroll was so great, but they weren't able to meet it. They amassed a payroll tax liability, and that accumulated over so many payroll periods, so many quarters, so many years. So I have represented clients with payroll tax liability of well over $1 million. I have seen clients with payroll tax liability of under $25,000. Those people, I love to give this bit of advice. If the liability is under $25,000, sure, there are hundreds of tax resolution companies around that could help.
Yeah, what's up with those? You hear the ads and it sounds almost like hucksters. They're trying to sell you something rather than provide a service.
Well, they are manned with very good salesmen, and certainly some of those companies will do a very good job. But if the liability is under $25,000, you don't really need them to do a very good job, because the IRS's process of collection has actually been streamlined. In fact, they call it the Streamline Program to assist those people who owe less than $25,000. With one phone call, they're able to usher them right into a payment plan or some sort of deferral that assists them. And at the end of the day, it really helps the government collect the tax, gets them on some payment agreement, whether it's pulled monthly out of a bank account or a paycheck or whether they just write checks, or whether maybe if it's deferred for a number of months or years until that person's back on their feet and better able. All right. So, but that's for very small liabilities. For the much larger liabilities, it's really not a do-it-yourselfer process.
So it would be like somebody operating on themselves, or instead of going to a doctor for an appendectomy, or you can't always do it yourself unless you live in this, you try to do it every day. It's not a do-it-yourself repair project.
It's not a do-it-yourself repair project, and it's a interesting analogy that you made there. But kind of going back to your earlier point about those other tax resolution expert companies, again, some of those companies do a very good job, but it's important to find representation that's going to fit the way that you really operate.
Your experience, you've encountered some tax resolution advertisements on AM radio, and I'm wondering what that's all about.
Well, we hear the advertisements. If you owe the IRS $10,000 or more, call us, call a tax resolution expert. And we've seen so many of those companies because at some point the bar of entry into that industry became very easy, and it became a very popular business to get into. Now the problem is not everyone does everything. So you have some companies that are very well fit for smaller liability, and very few tax attorneys that specialize in larger liabilities, company-centered, payroll tax-centered liabilities, those problems that are layered with other problems, be it pending divorce or possible other cash flow problems at home. Seen a lot of foreclosures that have been sprinkled into our tax client fact patterns.
That's it. On that note, we're almost out of time. I wanted to thank you, Mr. Collins, for joining us. And at the end of the show, we'll list Mr. Collins' contact information for those who are interested in more information and have questions relating to their tax situation as it relates to the IRS. Thank you.